It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and today we have probably our how should I say, our most frequent and well-liked guest, I should say. John Burley has joined us again today. And John, thank you for joining us on the show.
Oh, Ference, everybody listening, it's great to be here again, my friend.
Awesome. So John probably doesn't need an introduction, but I always get told by the station that we have listeners come and go. So if you don't know who John Burley is, he's my real estate mentor. Probably the person that knows more about real estate and more experience with real estate than anyone else I know. I know, John, you own thousands of single-family residences here and many other states and other countries, in fact, right?
Yeah, we've been blessed. We great organization, found the private equity company in 1989. Financial background, not that unsimilar to yours,
right?
And doing the real estate and enjoying, actually, which will be a surprise to many people, enjoying the changes and the bit of chaos that's come into our market.
Well, that is interesting, and that's why I wanted to have you come back on, because obviously the big news right now economically is the Federal Reserve aggressively raising interest rates. We haven't seen that for over a decade, and now we're coming back to things that people haven't seen in decades. So what do you see happening? How do you see this affecting real estate in general and locally?
Yeah, so I started in real estate in 1980. So when I was still a teenager. So obviously, interest rates were 19% back then. So there's a little different perspective for the veterans versus the people that are newer. With that said, I mean, the interest rates are going up. And it looks like the current Fed is going to do exactly what every Fed has done, whether it was Republican or Democratic based, in modern financial history. They're going to overcrank. And I could just imagine right now, I'm not in that room, so I do not know, but I could just imagine literally when they first started the interest rate increases, the advisors to the president going, sir, half a point, let's wait 6 months, half a point, let's wait 6 months. We didn't get here overnight. We're not going to fix it overnight. And like every single administration, Democrat or Republican, they've overcranked. They'll continue to overcrank, and they'll crank to where they go too far.
Right.
And then it'll snap back. In the interim, what it's doing is it's putting a lot of emotion, of fear into the marketplace, which if you can step back from the emotion and be a professional, these are the turbulent times when a lot more money can be made. When everybody's going in the same direction, there's less money to be made, and when the merry-go-round as it was stops, you're stuck. And so the interest rates are higher. They're affecting, certainly the most would be the homeowner. And these are where, I sit and ponder, and if you or I were sitting around at night, having a beverage, we'd have this conversation. It's like going, okay, so if they're trying to stop some things and not others, why don't they just common sense? Why don't we have a 2% rate for homeowners and a 5% rate for investors, if your goal is to stop investors from buying so much?
Well, that would be like too common sense, John.
Well, and it would work. That would be the problem.
Right.
So we can't do that. This is
right.
Government, so this option's out the door.
Right.
And so where we're at is, in my opinion, they're going to continue to raise the rates. I don't think we're going to see 19%. I don't think we're going to see 10%. At this point, could I see whiffing 7? Yeah. I don't think so, but yeah. And I wouldn't be stunned if they did.
Right.
And it's been artificially way too low for way too long.
Yeah, anybody that's listened to the show knows I was railing about that for well over a year, saying, what are you doing? They had the artificial rates held them far too long.
Yes.
But they were also buying mortgage-backed securities and buying bonds and throwing money into the system, and it was already inflationary.
Right. Yeah. And you've got, in the real estate market locally. So, let's talk about that. So people are like,
Yeah.
There's going to be a bubble and there's going to be a crash. It's like, based on what? All the people who use charts and graphs and basically worship them.
Right.
I mean, I look at them. I just look at them objectively, because all they do is show me a history of what's happened in the past, which I can use as a predictor for the future. But it is no facts of any way, shape, or form. It's just what's happened in the past. That's all they are. And, so what I love is when the chart and graph guys and gals are screaming bubble crash, but it's like, yeah, but your own charts prove that can't happen, because the reality is the 2008 downturn, the 1932, these are measured metrics that happen every 65 to 90 years that have never, not just in the history of America, but in the history of the world, have never happened back to back. I mean, there's 6,000 years of real estate charts, and you don't have back-to-back major crashes in history. Not that it couldn't happen, it simply has not in 6,000 years. You know, in America, we had, 2008, those of you that were live and listening, which would be most people here, look, it wasn't that big of a surprise if you stopped and look at it after the fact. The next one before that was 1932. That was a long time. The one before that was 1870. Well, we'd had a civil war, and the country was basically bankrupt. And then the other one was in 1790, which again we had a Revolutionary War. And so these are regular things. So, the thing that hasn't been fixed is supply. The last crash, 2008, we literally here in Maricopa County, Phoenix, which is where my company's based, where I live, we literally had 7 years of inventory. There was 220,000 doors with no family to live in them at $1. We simply had overbuilt that much on the speculation. So it was years and years just people moving here before the market could pick up again, because we had a huge supply issue, which this is what's interesting, parents. Then everybody understood, there's too many houses, so the prices can't go crazy until the houses come back. And everybody got it. And now we're the exact opposite. There's too few houses, and prices won't stop going up until we have enough houses. And suddenly we can't wrap our minds around that. So the problem is supply hasn't been fixed. The other issue in the real estate market is there's several different people buying now. There's a whole new buyer that didn't exist before, and that's institutional, which is what we are, who are buying predominantly cash and holding for decades. So if you're buying cash and holding for decades, interest rates don't affect you because you don't use borrowed money. And what a lot of people don't get, I hear this all the time with the institutional, what Zillow did this, they lost all this money, I don't understand. It's like, what you get is you don't understand. Zillow was not about real estate. It never was. It was a stock play, and they made billions and billions and billions of dollars on that $800 million paper loss. So they made money on it. Most of the institutional, literally what they're doing is we're taking treasuries, which are paying a little over 3% now, and they're investing in real estate for the long term, and it needs to beat 3%. That's not hard, buying cash with rents they are. So I think, we're going to have a slowdown in the growth in Phoenix, certainly. Homeowners getting squeezed and pinched hard because, the federal government can't figure out how to have different interest rates for different needs. We're already seeing, however, in the marketplace, certainly the amount of pressure to buy houses, no. It's absolutely changed in the last 60 days. A lot more properties are available, a lot better prices.
So the bidding wars have kind of gone by the wayside.
They're still there, but they're a lot softer. We're still about half the properties are being sold for above list, but also that's misleading because a lot of the properties the listing prices were lowered. So again, we have our chart that says, 50% are still above. Yeah, but the price was lowered.
Right.
So I think we're definitely seeing some softness. There's some weak points for the very astute home buyer, for the investor. There are more deals appearing in the cracks than there were 3 months ago, certainly, and there's less pressure. And you'll see more and more of the investment community, the highly leveraged, the speculative part of the community, which we're not a part of, but I'm very aware of it. You're going to see them moving out more and more because there's simply not going to be the ability to make the money that they would like, because we're not going to have the runaway appreciation. I think it's still going to go up, and that's just an opinion.
And their borrowing costs, of course, are going up. So.
Their borrowing costs have gone up exponentially, and they're not leveraged. And then with that said, I work with a lot of investors, who put 20% down, take out a loan, own the property for 10, 20 years, make hundreds of thousands of dollars during that period of time on the property, and they're good. Our spreads, our cash flow is not quite as high as it was 60 days ago, but still good. And people just go native and they forget rents are going up exponentially, just like the house prices.
That they are.
And I know here in the Valley, there's all this sticker shock around rents, but the reality is most of this, the last 3 years rent increases, was simply moving us to where we should have been for the last 10 plus years. We were. If you look at it nationally, our rents were so extraordinarily low compared to every other major market, and so a lot of that was just supply and demand. And yeah, it sucks. A lot of good people, regular families, can no longer afford to rent a 3 or 4 bedroom house. They have to rent a 2 bedroom apartment. However, it is still the cheapest of any major area, population wise. So, if we were in a California market, we don't even need to do California. Go to Houston, go to Philadelphia. They were already in a 2 bedroom apartment. The 3 or 4 bedroom house had already been out of the ability for them to do for a decade plus. And that's a whole other conversation, but just to have some perspective.
So it just caught up to us here. It's catching up, I should say.
It's Phoenix. Catching up, yeah. Which, if you're a renter, it sucks. If you're an investor, it's great.
Right.
Yeah.
So that's awesome. So obviously, you're still buying houses.
Absolutely.
And you have a system called the Burley method sometimes. And I know you have people ask me all the time who are interested in real estate investing. Maybe they've done it, maybe they haven't. Maybe they've had some success or not so much success. I always tell them, well, you probably need to educate yourself first, just like any business.
Absolutely.
So you have a boot camp coming up.
Yeah, we have the Burley Summer Camp. It's July 22nd and 24th, so it's a week and a half away. It's a very low entry. It's $197 for 3 days. They're packed full from 9 o'clock in the morning to 5 o'clock at night. One of the nights we go to about 9 or 10 with an optional, networking event that we do. You've got investors not just from Phoenix and Arizona, but from all over the country that come in, and we're teaching just high-end advanced strategies, starting out with, the common sense, lay the foundation for people that are newer. And then moving forward to the really advanced, and we talk about how to raise money, how to have lower cost of funds, and the sexy creative financing stuff, which is already starting to come back. Literally in the last 2 months, techniques that we haven't used in 7 or 8 years, we're now using again.
There you go. And I can say this, and that's why I invite John back on a regular basis, is because I attended that boot camp some years ago now. But I think in the 3 days, I don't know how many pages of notes I took, and I had been a relatively experienced real estate investor already. So, folks, I can tell you the amount of information that John shares, and what I even learned personally, for a couple $100, oh my gosh, it was one of the most efficient, best uses of my education dollars I've ever had. So, folks, go to johnburley.com if you're interested in more information. He's got this boot camp coming up July 22nd through 24th here in Phoenix. And I'm going to encourage you to stay tuned through the next segments because we got John with us all day. So we're going to talk more about real estate. So stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And we have one of our favorite guests with us today, John Burley, real estate expert, educator, investor, private equity, whatever you want to name it, best-selling author. If you don't know who John Burley is, I really encourage you to go to johnburley.com. He has a summer camp coming up. John, tell us a little bit if somebody is interested in learning more about the Burley method, I guess.
Yeah, thank you. It's July 22nd through 24th. It's just $197, so it's very, very affordable. 3 days, high-end content. If you've been to other investment seminars, this is not one of those. So first of all, I'm the speaker. We don't have a speaker coming on every 2 hours selling the greatest things since sliced bread. We have an attorney that comes in who's not selling anything, just to clarify for everybody asset protection. There's a lot of misconceptions. A lot of people in the education industry have massively overcharged people for things, and so he just shows you what you really need, how to fix it, how to do it. We do have an expert panel, which is always cool. We bring up half a dozen homegrown, highly successful people. And what's successful? 100+ properties in portfolio, cash flowing 50, 60, 70, 80,000 a month net profits. We actually take a field trip where we run the people out to my office to show them what a real bricks and mortar real estate investment company looks like. And what we do is we lay the foundation. This is how the money is. This is how we raise money. This is how we get money. This is how we buy properties. And what's really cool right now, Ference, is because we're having some softening in the market. There's no crash going on currently. Not that there couldn't be, but we talked earlier, it's unlikely. there's definitely a softening out there. And there's a lot of people who are fixed on, I want $500,000 for my house, and the reality is they ain't going to get $500 anymore. And with those people, we're able to go back into our toolkit, take the toolbox back out. And so we're really going to be spending time going over a lot of the creative financing, things like subject to and mirror wrap and owner financing at like 0 to 2% interest. And the reason we're able to do those things again in this market is because there is some softness. And those people who are really hung up on their price, obviously the wholesalers and the institutions aren't going to buy their house for way more than it's worth anymore. Those days ended. They'll come back again in 8 to 12 years, but those days for now are over.
Right.
And so with the owner financing and the subject to and the mirror wrap, it's a way where an owner can get their price if they'll give better terms. And the way I was taught and what I've been doing for the last 40 years is like, look, I can make a lot of money, but I have to buy wholesale. I have to get wholesale price or wholesale terms. Right now, wholesale terms are easier to get than wholesale price because there's not a lot of supply. But there's people who still want that premium price. And so we're doing a lot of that creative financing. And a lot of people, especially newer investors, really love it because creative financing usually does not require much money down and rarely requires the ability to qualify for a loan. And so for a lot of people, that's bingo, bingo, bingo.
Right.
Because they're not in a position to put up a lot of money down. They're not in a position to qualify. It's a great avenue to get in. That softness is there. We're actively in the market. Here in Arizona, through our teachings, we have literally thousands of people who became millionaires, most of them in 18 months to 3 years from our teaching. And so, I'm talking with them all day long, all across the state, all across the country, literally, and all around the world. And then with our own operations, we're buying and selling. I mean, there's definitely a shift in the marketplace right now. Metrics are showing it some, but there's a difference between a spreadsheet of what happened last month and what's happening today in the street and what the true emotion is. And so we focused on that. What's really going on? What are the feelings? What are the emotions? I mean, realtors literally 90 days ago thought, hey, all I got to do is get a license, list a couple houses, and get rich and never work. Right. Well, those realtors are having a lot of trouble right now because it's not working. It's back to the old days where you've got to go out and be creative and do something other than just be alive to make money in real estate.
I could see that. Yeah.
Yeah, and so we just got that shift. So we're seeing some really great opportunities. We're obviously buoyed by extremely high rent. Mm-hmm. If I'm doing shorter term deals, which we're going to talk a lot about the wholesaling on that, we do want to really be cautious because there's so much pressure to overpay by investment community and by long-term cash investors, which is a whole new gambit, which was never really a major factor.
Yeah, that kind of changed the landscape fairly recently.
It started in we were the first to go out in 89.
Yeah, but I'm saying in a big way.
Yeah, it became big in the 9, 10, 11, 12. Mm-hmm. But a lot of them were shorter runs and stuff. And what we've seen in the last couple of years is there's been some very, very large, well-known institutions and some very large, not well-known institutions who are literally taking markets like Phoenix and it's like, we're going to put $100 or $200 million per year into single-family homes that we're going to hold for decades. And we could go on and on all night, all day long about looking, well, this isn't fair. These houses are being taken out of inventory, yada, yada. There's nothing we can do about it. What we need to do is accept that there's these new massive giants, dinosaurs, who are buying this stuff under a very traditional model. I mean, literally all they're doing is the mom and pop real estate investor, and most of us know somebody, every year or two they buy a house, they fix it up, they rent it out, they hold on for 10 or 20 years, and then lo and behold, miracle of miracles, 20 or 30 years later, they have 20 houses free and clear, and they have, $20,000, $30,000 a month income stream. It's like, how'd they get rich overnight? Well, it's a pretty long process. So you've got the institutions, some of whom we work with, that are really, really, really embrace the long-term hold. And my conversations with them, literally, it's like, if we can make above 3%, if we can beat a treasury, with all the other benefits of long-term it going up in value, et cetera, if we can cash flow above 3% cash, we like this better than T-bills. And that is the shift. So they're not looking to make 10 or 20% or anything crazy like that. They're just looking really conservative. And there's two opportunities. One would be to buy and sell to them. I always scratch my head at that. Mm-hmm. So many people in the real estate community are like, oh, I don't want to be involved with them. It's like, well, they're here and they're going to buy from someone. Why not you?
Right.
And then the other thing is that they are going to help massively stabilize the market. So, as you move into markets where 10, 20, 30 in some parts of the country, it's going to be closer to 40% of the single-family homes in the Class B neighborhoods. They're not buying mansions. They're not buying the slums. They kind of figured out slums aren't good. Mansions aren't good for cash flow. It stabilizes the market incredibly. So even if the market was to go down, they're not selling. And you can't default on loans you don't have.
Right, because they're paying cash.
They're paying cash.
Right.
And we work with different clients who have different needs. The majority of our clients finance. However, we have a large number of clients who just don't want to have any debt. They just buy cash, and it's like, and there's nothing wrong with it. It's what they want to do. And, on that, the more houses that are owned cash by investors in the marketplace, the more stability. So
there would be less volatility because they're not affected by the interest rate environment as it's going up and down.
Right. And a lot of people are looking at whether we're going up or down. Some people are like, well, we're going to have stagflation. Well, a lot of people look at real estate, residential real estate, as one of the greatest hedges against stagflation. Mm-hmm. A lot of people look at it as one of the greatest hedges against inflation. Mm-hmm. And so you've got a lot of very, very big, smart money moving in, and this is smart money that's got a proven record. They make money. And so there's a lot of things that the listener and you and I can learn from them.
Absolutely. So you've got a summer camp coming up, like you said. It's on July 22nd through 24. If you want more information, go to johnburley.com. Stay tuned in the next segment. We're going to share some more real estate information with John. And as I've always been saying recently, if you want to learn how to navigate this economic chaos we're dealing with, contact me at yourpersonalbank.com for more info.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we have one of our favorite guests, John Burley, real estate expert. If you missed any of the previous segments on this show, I'm just going to really encourage you to go to yourpersonalbank.com. You can listen to this or any of the previously recorded shows. I've been asking John, what about real estate, particularly recently with the increasing interest rate environment, what to expect, what you should do. But another thought I had here, John, like you were saying, I think is interesting, is you were just leaving the thought on, real estate historically has been a hedge against inflation, things like that, stagflation, various things. And a lot of people have qualified accounts, qualified monies. A lot of them are struggling in the stock markets, particularly this year. 2022 has been rough, the worst since 1970, actually.
It's been
bad. It's been a rough first half of the year. So if somebody was thinking about diversification, maybe into real estate, maybe using some qualified monies, what would you recommend?
I love the retirement account money used for real estate. It's a great, great natural fix. I mean, everybody's heard about flipping and wholesaling and all of that stuff, but the reality is, whether it's a small apartment building, whether it's a group, a portfolio of homes that you put together, whether you build it yourself, 5 houses, 10 houses, whatever it is. I love the single family real estate because it matches what the goals and objectives are of pension money, of retirement money, and IRAs and 401ks, in that it was designed for the very, very long term. I mean, people short-term trade, quote-unquote, real estate, but your cost of trading is 9%, 6% commission, 3% closing costs. I mean, imagine if we had to pay 9% to trade a stock. No one would short-term trade.
Right, no one would do it.
And so they really, what the asset class does matches what the purpose of the retirement account is really great. And you can, for those of you guys that aren't aware of it, we'll cover it at the event, July 22nd, 24th. You can very simply and easily self-direct IRA money, 401k money. I have doctors and dentists and high-end clients who self-direct defined benefits, which, if you're not aware of it, guys, that's the account where you literally can put away 100% of your salary every year and pay no income taxes if you want to.
I've worked with many clients like that.
Yeah, and it's a nice problem to have.
Exactly.
It's one we should all strive for. But I love putting them in there because the real estate, the great thing about it is that you buy a solid property once. And look, you do this for a while, you will get those deals of a lifetime. But it is called a deal of a lifetime. So the odds of it being your first deal is pretty rare. Just like the first stock you bought wasn't Microsoft in 1987, okay?
Probably not.
Probably not. I mean, and then even if it was, you wouldn't know what you had.
Right.
So we just teach by, what the great deals are and then what the solid deals are, which is the mainstay of most portfolios, that make nice, great rates of return, go up in value over time. You can even, a lot of people aren't aware of this, you can even in a self-directed IRA or 401k, you can even borrow 65% of the purchase price. So, a lot of people are like, well, I got enough money to buy a house. It's like, oh, I could get 3 instead of 1. Well, 3 would be better than 1. It's like, yes, it would. Mm-hmm. Everything, that we're buying today is positive cash flow. One great thing, with the rent going up so much, and people are like, well, how much? And it's like, literally, a house that I got in 2019, $1,200, $1,250 a month, I have applicants beating my door down to take it for $2,100 in 2022. July. I mean, we just had one we moved for,
So basically double.
Almost double. Almost
right.
double. Yeah.
And that's in what, 3 years?
3 years.
3 years.
The first big move was it was so far behind. People are like, well, it's not sustainable. It can't go up. And it's like going, well, whoever's saying that is disregarding facts, because the reality is the money is there. And yes, it is unfortunate, and I'm not excited about the fact that there are a lot of families who were blessed in Phoenix to be able to rent a 3 or 4 bedroom house that are now moving into apartments.
Right.
But I'm not in charge of that. They were ridiculously low. As much as government talks about, wow, we want to take care of things, it's like, well, you just keep putting more rules and more taxes and more fees on building. There's a reason why builders don't want to build. And why they don't want to build modern income housing. They don't make money on it, and there's a lot of risk. They make way more money doing better houses. And the government, if they want to solve the housing, they need more conducive. Now, fortunately, we're in Arizona. We do it way better than our neighbors to the west. However, there's a lot that could be done on that. So the rents are so high, and the big rent increases preempted the interest rate increase. So we're mostly offset. We're making a few $100s less. People go, well, what do you make on a house? On a single-family home here in the Valley, bought for $300,000 to $400,000 at 100% of retail price. We were making 90 days ago $1,000 a month. Today, that house is down to $600 to $700 a month.
Okay.
With that said, your first year is your worst year. Because after that, rents are just going up and going up and going up. And I think realistically, people go, how much? I said, I think that we'll go 18 months to 3 years of continuing rents, at that 8 to 12% per year pace. Right. It just is.
Hold that thought, John. We're going to carry over the next segment. We'll let John finish his thoughts on what's going on. If you want more information on John's boot camp, go to johnburley.com. July 22nd through 24th. It's an event I recommend attending if you want to learn about real estate. Stay tuned in the next segment. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And like I've said, if you've been listening, we have one of our favorite guests, John Burley, real estate expert, private equity owner. This guy knows more about real estate than anybody, frankly, I've ever met. And so that's why we invite John back. The listeners love John. They love I get more responses from your shows than any other. I'll tell you that.
Thank you. I appreciate it, everybody.
Yeah. So welcome back to the show. And I want to go back to kind of where we started a little bit, just kind of rehash a little bit. The big economic issue of the day right now is rising interest rates and high inflation. So where do you see real estate, both for homeowners, renters, and investors, how all this is going to kind of play out here in the near to medium future? Yeah,
great question. And I get it all the time.
Right.
And the one you hear all the time is like, well, I'm going to wait for the next big crash and I'm going to get in. I've been having people tell me that since 2012. And they just missed the greatest run in the history of the world. Mm-hmm. The reality is, if you know what you're doing and you're properly trained, it's always a great time to buy real estate. In times like this, we have to be extraordinarily selective. Let me be really clear, listeners. I'm not just willy-nilly buying any house at random off the MLS. we do buy off MLS, but we'll show you very specific parameters, type of neighborhood, income streams, because we're looking at it as an investment, not as a resident to live there. Your interest rates hurt you more than the price increases, which is people are just finally getting it. Everybody had a calculator available to them.
Right.
But while the prices were going up, they weren't factoring it in because obviously, interest rates going up a couple points is far more devastating to a return on investment than the price going up 50 grand.
Well, a perfect example, John, is I've been sharing, not just a few months ago, somebody with really good credit could get a 30-year fixed mortgage for 3% or less even.
Yeah.
And now it's over 5. It's going to be 6 very soon.
Very soon.
Doubled.
And I think we'll see 7-ish before things are enough of a shambles to think about stopping. And
give you an idea to kind of further, I just this morning was speaking to one of the bankers who we do our, the lines of credit with the Cash Value Life, and their projections, this is one of the big banks we work with, they're expecting 6.5 to 7 in the next year.
And I think unfortunately we're on track for that. Even though every administration, both parties, when they were in the situation, did the same thing and it never worked. This is what our brilliant minds come up and do with. So here's what we know is always getting in sooner rather than later is better. Waiting for a crash. So let's be clear on this. This is about one psychology and emotions. If you trade stocks and you're waiting for a crash, that means you're 100% all in right now, not in the sidelines. Be like, well, if it goes down, well, if you're trading stocks, you should know about the tools that are available to protect your downside. If you don't know what those are, you shouldn't be trading them.
Yeah, you need to know what stop losses are.
Stop loss is like toddler. It's toddler mode, but that's the basics.
Things.
Yeah, and yet most planners trade without them.
Right.
And most individuals trade without them because you don't need to take huge losses.
Right.
In real estate, we're looking more the long term. And one of the intrinsic amazing things about the asset class and how it's viewed on by lending institutions is, unlike a stock account, there is no margin call.
Right.
If the property goes down in value, nothing happens to your financing, nothing happens to your property. It's just in the short term worth less, and the rents still come in every single month, month after month, year after year, decade after decade. So it doesn't matter.
And this is something I learned from you, actually, John, a number of years ago when I talk to clients who have rental real estate. I asked them the question, why are you in this? Are you in this for cash flow or appreciation? And so when most of them are like, well, cash flow.
Yeah.
Then I said, do you care? I learned this from you. Do you care what the value is, up or down?
No. Because the thing is, and I think what happened is, through mutual funds and through stocks in the 60s and 70s and 80s, and then just regurgitated on and on after that, is the buy and hold doesn't work in the stock market like it works in real estate. There's some things that work, but it doesn't work the same because in the stock market, if you've used leverage, margin, it does matter what it's worth. Where with real estate, it doesn't.
Right.
So the real estate, it did in 2008. Your portfolio can fall 50%, and as long as you're cash flowing, it doesn't matter.
Right.
Now, what you're going to see is you're going to get people who are going to start doing negative cash flow and stuff like that because they're not properly trained. But I mean, I've never done all the thousands of properties we've done. I've never done a negative cash flow property in my life. I never would. Some I held longer because the market went down.
Right.
Others, the market went up really quick. And I was trained, how I look at it is, the growth and the appreciation. That's like the whipped cream on top of the ice cream. Boy, it's wonderful. It makes the ice cream taste better. Forget about calories and healthy.
Right.
It tastes good.
Right.
But I don't need it to enjoy my bowl of ice cream. And at the end of the day, your small multi-unit, your single-family home portfolios, those are just a bowl of ice cream. And you can sit there and eat that endless bowl of ice cream whenever you want. And the only time we look at selling is when the market's up. And right now, the rents are so great that we're not selling anything. We're adding to our portfolio. We like the long-term income stream. It mirrors retirement accounts beautifully. It mirrors regular income stream because at the end of the day, I think everybody listening here just wants the exact same thing that my capital investors want, the exact same thing my students want, and the exact same thing I want. I want to have the ability to retire better, sooner.
Right.
Now, I continue to work but I enjoy what I do a
Right.
lot. But I don't work the hours I used to work. I
Right.
mean, as you know, like
Yeah, I do know that.
we spend almost the entire summer up in Cholo at our place up there because
Because you can.
we can.
Because you can. And I like what you were sharing earlier too, because like you mentioned, using the IRA the retirement qualified accounts in particular monies in the real estate investment side. I'm a big fan of that too, because like you said, the two match really well. They're long-term investments
Right.
or retirement cash flow. And I like the balance of using that, and then like the non-qualified funds with the insurance creates the tax-free bucket.
You've got both going at the same
Now
time.
you have a taxable bucket potentially, and you have a tax-free bucket, which gives you options.
Right, and they grow. And I really like the protection of the long term on the real estate and retirement account because, hey, we don't know. 5 years, 10 years, 20 years, 25 years when you're coming to retire, if the real estate's down, it doesn't matter. You just take your income streams
Right.
and you wait for the real estate to go back up. But you
Right.
build up those incredible real estate. And the thing is, what a lot of people forget, with residential real estate, your first year is your worst year. It gets better every year after that because the income streams go up and you learn to put in proper residence.
Right.
We prefer them to have skin in the game and ability to own, and just it gets better and better and better and better and better, which there's a reason why so much intelligent institutional money is pouring in. I'm not talking the guys that we're doing the flips and the in and out.
Or some of the folks with billions.
Yeah, with billions and billions
Yes.
who are looking at this going like, hey, this is a great, massive long-term thing. And what you got to understand is their main psychology and emotion is what they really want to do more than anything else is to preserve the capital.
Mm-hmm.
You know, and so they know that the asset class of residential real estate, which is different than commercial real estate, which has
Right.
a whole different set of risks, because obviously if a bunch of businesses go under because of inflation and a bad economy, those buildings no longer perform.
Correct.
Where single-family homes, somebody needs to live there, and here in Arizona, we're so underbuilt currently, and will be underbuilt most likely for at least a decade, if not longer, because it's cost prohibitive to build the housing that's needed. Nobody wants to. It's like, why would I take the risk
Right.
without the upside, and the government won't intervene on those? I don't understand. I never have why they can't just do what a normal business would do. I'm going to make exceptions, and I'm going to fix the things that need to be fixed rather than make it all blanket for everything. Like
There you
we
go.
talked about originally. Why is everybody paying essentially the same type of interest rate? If you really want more FHA and VA loans, which is a good thing in my opinion, then modernize the practices of how that business is run, because it's basically run like something from the 1950s.
Right.
Modernize the appraisals and give them a lower interest rate so they can. And then incentivize the builders to build the houses.
And that would give the homeowner an advantage who wanted a primary residence. They'd have a lower rate than the investor had. And yeah, that to me, that just makes logical sense. I want to go back to the thought you had with the retirement monies, though, because
Absolutely.
one of the things is for the investor, when they hit age 72, they got the required minimum distribution. Well, if they say put a chunk of that or a significant portion in real estate, their R&Ds wouldn't be as significant as they would in a typical investment account, would they?
No, they wouldn't.
Because they're only taking the income,
Just
the
taking
cash
out the
flow.
income streams. Right.
Right.
And the income streams are coming out. Long-term capital gains, which is,
Right.
is still, with the exception of California, is still a favored, in every state and federally, is still favored income stream, a lower tax rate. And obviously if it's in a Roth, then it's irrelevant because
Right.
there is none. And we have people do both.
Sure.
I've done the math myself, but I have a hard time when I'm talking to a couple who have $2 or $3 million in a retirement account, and their financial planner has told them to, convert it to a Roth. They're just like going, I ain't paying 40% to the federal government on purpose.
Right, and depending on their age, their numbers can be rough.
Then the numbers can be rough. Yeah. And,
Yeah.
and usually it's the ones with big accounts where it'd be rough. If you're
Right.
younger, convert the dang
Yeah,
thing.
move on.
Yeah.
Yeah.
It's
Bite the bullet, move. I do the
Yeah.
same thing. If you're younger, it's not a huge amount. Bite the bullet, move on, grow tax free. But if not so young, and
Yeah.
you've got a significant chunk.
Yeah.
Yeah, I think the real estate could be a really good fit for somebody, particularly somebody these days where, let's face it, the stock market's had a great 10-year run or so.
Yep.
I mean, easy monetary policy, all that was contributing, low interest rates. That's all. What I've been stressing with people is, look, all that's changed. We're
That's
in a
all.
different ballgame now.
That's completely gone.
Right.
The stock markets, to give people comparative, the 10 years of the stock market were crazier than the last 3 years of Phoenix real estate.
Right.
The difference with Phoenix real estate, unlike the stock market, is Phoenix real estate has factual massive supply issues. There simply is not enough properties for people to live in. Therefore, you are not going to have, from any rational common sense, any charting, we do not have a bottom falling out like '08.
Do you have any like data or information on maybe some other markets that are having similar or maybe more different scenarios, or maybe there are more opportunity where there'll be a fallout?
Yeah, you've got
that you've seen.
There are places of weakness in the South,
okay,
however, and the Midwest, which are very low price. People are like, oh, I'm going to go buy houses in Oklahoma because they're only $100,000. There's a reason they're only $100,000. They never go up. Okay,
right.
So 20 years ago it was 90. It's
right.
now so it's like you're not going to get growth like Phoenix buying it dirt cheap. It's not
right.
like it was under the radar.
Right.
Almost no one lives there for a reason. There is just simply not the jobs and the growth. They're beautiful places. I've invested in several states in the Midwest and the South. There are some weakness there. However, the new dynamic is that for the last decade, lots of long-term institutions have been buying. And you got to understand, you got the ones who like to flash it in the media.
Right.
Most of the big buyers have been just like us. They're under the radar. They know how to buy not all in one account. They know how to buy with their various entities. They know how to make it difficult to analyze who's taken what positions. It's
right.
like, well, that's
it won't be so obvious.
It's just no different than like what Walt Disney did in Florida and California. You buy
right.
it through all kinds of entities. Nobody
right.
knows who's done it until it's already done.
Right.
And so you've just got a large percentage. And I think from my sources, the long-term institutional ownership is far higher than what people think it is.
And I think it's interesting, your thought. I hadn't heard this from anybody before, where you feel like that's going to create some stability in the overall real estate market with a higher institutional ownership percentage.
But yeah, so first of all, normal markets, take 8 out. Normal markets, investors are actually more stable than homeowners.
Right.
They have more skin in the game, and it was bought usually as a business where it had to actually profit. Where homeowners are just like, unfortunately, they're led by their advisors to the highest loan you can get, take out. Whether or not you can afford it is irrelevant.
Yeah.
Which,
Well, John, it's been awesome having you with us. I'm going to encourage folks to attend your summer boot camp, one of the best trainings and most affordable. It's when and where can they find out more information?
July 22nd through 24th. It's $197. We have an early bird special that we're holding open for the show. It's johnburley.com, JohnBurley.com. Feel free to call the office, 623-561-8246. Look forward to seeing many of you in July and teaching you how we do what we do step by step.
That's awesome. John, thank you for joining us. And for more information on what we do, yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.